It's 3 a.m. Markets are closed. ATMs still work. Your bank app still opens. Lights are still on. Behind the scenes, trillions of dollars just vanished. And almost no one panicked. That's not an accident. That's the point. Financial systems aren't designed to be fair. They're not designed to be efficient. They're not even designed to make sense. They're designed to survive. Even when everything breaks. And that uncomfortable truth matters more right now than most people realize. Because every few years, we're told the system is on the brink. A housing bubble. A banking collapse. A debt crisis. A currency shock. A once-in-a-lifetime event that somehow keeps happening. And yet, the system limps on. Bruised. Reshaped. But still standing. So today, let's talk about why financial systems are built this way. How they actually survive crises. And what that survival quietly costs the rest of us. Not the theory. The mechanism. Because once you see it, you can't unsee it. Let's start with the uncomfortable question no one asks. Why does the system always get rescued, but people don't? Think back to the last big crisis you remember. Banks were collapsing. Markets were freezing. Headlines screamed. Systemic risk. And suddenly, rules changed. Money appeared. Emergency programs launched overnight. Losses were absorbed somewhere, somehow. This wasn't chaos. It was choreography. Financial systems are engineered like modern airplanes. They're not built to never fail. They're built to fail without crashing. And that distinction explains almost everything. At the core of the system is a simple idea. If everything is connected, nothing can be allowed to collapse all at once. That's it. That's the philosophy. Your bank depends on another bank. That bank depends on a payment network. That network depends on central liquidity. That liquidity depends on trust. Remove one piece too fast, and the whole thing seizes. So instead of preventing risk, the system does something more subtle. It concentrates it, hides it, then spreads the damage over time. Think of it like shock absorbers. When you hit a pothole at full speed, the damage doesn't disappear. It's delayed, redirected, smoothed out. You still pay the price. Just not all at once. This is where the storytelling gets interesting. Because most people imagine crises as explosions. Sudden. Violent. Unavoidable. But financial crises are more like slow leaks. They build quietly. Pressure accumulates. Warnings get ignored. And when the system finally responds, it does so in a way that looks bizarre from the outside. Let's break down how. Step 1: Leverage. Leverage is just borrowed money. Simple enough. But in financial systems, leverage is everywhere. Banks lend more money than they physically have. Investors borrow to amplify returns. Corporations refinance debt instead of paying it off. Governments roll obligations forward. Why? Because leverage makes the system grow faster. And growth buys political time. The problem is that leverage also makes losses contagious. When one balance sheet breaks, it hits the next one. Then the next. Then the next. So the system quietly plans for that inevitability. That's where step 2 comes in. Backstops. Every major financial system has institutions whose real job is not growth, but panic control. They don't prevent bad decisions. They prevent synchronized failure. When markets freeze, they step in as buyers of last resort. When banks can't fund themselves, they provide emergency liquidity. When confidence evaporates, they replace it temporarily. Notice the word temporarily. Because none of this fixes the underlying problem. It buys time. And time is the most valuable asset in a crisis. Here's the irony. The same mechanisms that stabilize the system during collapse encourage risk during booms. If everyone knows the system must survive, someone will always push the limits. Because losses can be socialized. That's not cynicism. That's math. Which brings us to the hidden mechanism most people never see. Loss absorption. When something breaks, the question is never, can we fix it? The real question is, who eats the loss? And the answer follows a strict hierarchy. Equity first. Then debt. Then, if necessary, the currency itself. This is why markets can crash while the system survives. Stocks fall. Bondholders take haircuts. Purchasing power erodes quietly. The system stays alive by redistributing pain. And it's rarely distributed evenly. Think about inflation for a moment. It's often described as a policy failure, or a mistake, or bad luck. But in crisis design, inflation is a release valve. It reduces real debt burdens without triggering mass defaults. It transfers value from savers to borrowers. It keeps nominal systems functioning. Inflation feels chaotic at the grocery store. But from the system's perspective, it's orderly, cold, predictable, effective. This is where the story shifts from mechanics to consequences. Because while the system is surviving, something else is happening. Trust is being spent. Every time emergency measures are used, the public is told it's temporary, exceptional, necessary. And sometimes it is. But over time, those exceptions become expectations. Markets start pricing in rescues. Institutions assume liquidity will appear. Risk models quietly change. And slowly, the system becomes dependent on its own safety nets. Like a building that only stands because scaffolding was never removed. Now let's zoom out. Why does this matter right now? Because financial systems today are more interconnected than ever. More leveraged. More reliant on confidence. And confidence is fragile. It doesn't collapse gradually. It snaps. The irony is that the stronger the survival mechanisms become, the more catastrophic a true failure would be. That's the paradox. The system can survive almost anything, except the moment people stop believing it will. That's why crises are managed the way they are. Not to protect morality. Not to enforce discipline. But to preserve continuity. Continuity of payments. Continuity of credit. Continuity of daily life. Because the moment ATMs stop working, theory doesn't matter anymore. And here's the quiet humor in all of this. The system doesn't care if you understand it. It only needs you to trust it enough to use it tomorrow. Swipe the card. Accept the currency. Assume the number on the screen means something. As long as that behavior continues, the system lives. Even if the math underneath is uncomfortable. So what's the real risk? It's not collapse. It's adaptation without consent. A system that survives by changing the rules after the fact. By shifting costs invisibly. By turning emergency tools into permanent features. And eventually, people wake up and realize the system didn't break. It evolved. Around them. So here's the unresolved question I'll leave you with. If financial systems are designed to survive crises at any cost, who decides which costs are acceptable? And what happens when the system survives one crisis too many?